Appalachian Harvest is a food hub located in Southwest Virginia that provides regional herb and vegetable farmers with training, technical support, aggregation, and distribution services, connecting them to retail markets. We currently source produce from farmers in Virginia, Tennessee, West Virginia, Kentucky, and North Carolina. This webinar is made possible by Risk Management Agency 2018 Risk Management Education Partnership Program.
So why are you on the webinar? Why are you watching this webinar tonight? Why are you considering crop insurance? We have some farmers that need it for terms of a loan. If you are getting a loan for your farm business, or maybe the overall farm loan to buy a farm, even though you have a business plan and you have financials that forecast that you will make money, we don't control the weather, none of us. So many times banks will want it as part of a loan package just to help ensure, it's not a guarantee, but it will help ensure that there is some revenue from the farm. There's still situations where that could not be the case, but in general, it gives you a much better chance. Another reason to get crop insurance is to protect your investment in the farm. If the farm is your main source of income, or losing your farm income is going to create a significant hardship for you, you should consider crop insurance. There are a couple of different types we're going to go over tonight that explain that can be really valuable to a small farmer, and we'll go over that in just a moment. So, but first, if you don't know much about crop insurance, what is it? Where did it come from? Some background is it was created in the 1930s. If you remember, there was something called the Dust Bowl around the same time, and there was a lot of federal disaster relief for farmers. And they said, well, what if we created an insurance program to help cover farmers in case there is a disaster? So they created it. Today, the federal government works with approved insurance providers to get you coverage, which means that in most of most crop insurance programs, you won't go to USDA for insurance. There are companies that they have contracted with to provide insurance to you. And interestingly, people don't realize this, the rates are the same between the different companies. The rates are determined by the Federal Crop Insurance Corporation, FCIC. So it's really in the company's best interest to have a good relationship with you, to be easy to work with, to go above and beyond to make sure your needs are met, because there's no monetary reason that you should choose one insurance provider over the other. Also, the premiums on your crop insurance are subsidized by the federal government based on cost, and if you are a member of any special group. So what I mean by that is, depending on Farm Bill language, which we are still waiting on specifics, if you are in a minority group, if you are a limited resource, or if you're under a certain income level, if you are a woman, and it historically has been a way to qualify for reduced subsidy, all of those ways help get the cost of your premium down. So today they can subsidize from 38 to 67% of your premium, and I think it's actually in some cases a little higher than that. The 67% is in a general number. So we see it, we'll talk about NAP, they'll subsidize not your entire premium, but possibly your entire application fee, depending on your situation. So what are some things to understand when people start talking about crop insurance? Yield versus revenue. Farmers should be very familiar with this. Yield is how much you harvest, and they use your yield to calculate your actual production history. Crop insurance has no shortage of wonderful little shortened terms like APH. So when you hear APH, that stands for actual production history. We're not going to use these terms much tonight because this needs to be easy to follow. Revenue is how much you earn through sales. So, you know, you could have a great yield and have very low prices and not have great revenue. You could have a low yield but have great prices and so have good revenue. These two are related but not the same. It's important to understand that as we talk about the different types of insurance. Production practices. When we say production practices tonight, what we mean is it organic? Is it conventional? Is it irrigated or non-irrigated? Those are your production practices. And your coverage levels. So if you have $100,000 worth of sales on your farm, you, depending on the program, you can insure up to 85% of that. So that would be up to, you'd be insuring $85,000 in revenue. So you could do 50%, or you could do catastrophic, which is, you're under 50%. That's catastrophic. Other things are premiums. Premiums in this world means exactly what it means if you're paying your car insurance. It's the amount you're charged for the coverage. Subsidies, we've discussed that a little bit already. It's the amount of your premium that the federal government pays. Claims, just like if you wrecked your car, the claim is what happens when you've had a loss. If your pumpkin patch is flooded, if hail tears through your lettuce, whatever happens, that's the claim. Indemnity. Indemnity sounds like a terrible word, but in the crop insurance world, it is actually the payout after your loss is approved. So while you don't want to have to receive an indemnity, receiving an indemnity is the benefit of having crop insurance. So what fits a small and diversified farmer? There are two programs we're going to go over tonight that we've researched, and we've talked to farmers and insurance agents, and these two are the ones that fit the best in most small farm situations. That's whole farm revenue protection, and that's exactly what it sounds like. It's your entire farm under one policy, which seems intuitive. That's the way insurance should work, but that's not how it has worked in the past. So it's good for farms that have specialty organic crops. If you're marketing it locally to a consumer, so you're getting a higher price, you're doing heirloom, if you're, they say farm identity preserved, which means that they know where it comes from, who grew it, and so you can charge a little more. Basically, you're getting above commodity prices for your products. It does require that you have already done a significant amount of record keeping. However, I think you'll find that if you're organic, or if you're GAP audited, or if you keep good production and tax records, you will have the records necessary to apply for a whole farm. NAP, which is the Farm Service Agency's Non-Insured Crop Disaster Assistance Program, or we call it Non-Insured Assistance Program, NAP, much easier to say NAP. It is actually not purchased through a private agent. This was invented through a farm bill a little while back. It's purchased through the Farm Service Agency. You can go to your local FSA office and sign up for it. It covers crops for which individual coverage isn't available in your county. Wait, I just told you get whole farm revenue protection, which covers everything. By the way, it's available in every county in the United States. But this is this coverage for what isn't covered. This is for things that aren't available for individual coverage. It's not corn, wheat, or soybeans in the western part of Kentucky. You're thinking of pumpkins in eastern Kentucky, or maybe even soybeans in eastern Kentucky aren't covered. NAP will not pay a premium. We will see how they pay, and it's based on their market estimates and their yields per acre and your approved yield. So first steps, check to see if you have the necessary records. We'll go over that. And contact FSA and an insurance agent. The most important part of this process is probably finding out what's available to you, how much it will cost, and if you have what you need to get covered. In most cases, I think people will find that they do. I've been surprised by insurance agents, when you're selecting an insurance agent, since they all have the same rates and they all will offer you the same subsidy, you need to select the one that will go above and beyond for you. I spoke to an insurance agent who carries whole farm revenue protection, and he actually visits with farmers on Saturdays at their house and brings an accountant with him to make sure he gets everything perfect for them and gives them the best that they can get. So that's who you want to work with. You don't want to work with a person who doesn't really like doing a whole farm policy, who doesn't want to drive to your part of the state. You don't want to work with those. There actually is an agent locator through USDA's website, If you click that link, you will be able to follow it. And you can really just Google risk management agency, crop insurance agent and locator, or any of those crop insurance agent locator. You will get this locator. You don't have to copy this link and memorize it. So what records are necessary? The very basic and first thing is your farm serial number, or FSN, as it's commonly shortened. The name of the crop, what are you growing? Growing pumpkins. What variety? Are you growing pie pumpkins or jack-o'-lanterns? There's a difference, and there's different programs. Intended use. If you're growing peppers, are you selling them for fresh, or are you selling them for processing in a hot sauce? Those are two different things. Your practice, for example, irrigated versus non-irrigated, or organic versus conventional. You'll need that information. Your production history. When did you plant? Where are your fields located? Do you rotate? All of that stuff they need. They need to know what you've been doing. Basically, do you know what you're doing? And how are you producing what you say you have produced in the past? The total quantity of all your crops harvested during the 5 previous years. For beginning farmers, they will actually shorten this and they can make adjustments. But if you've been farming for a while, you need that. If you're doing fruit trees, there are some additional requirements I'm not going to go into, but generally the spacing, the age of the trees, the condition of the trees, all of those are very important when they're putting your policy together. So what is available to me? So I am going to show you all a tool from FSA that gives you an idea. So I'm going to just bear with me a moment. So I can't say that soybeans are covered in all of Kentucky, or pumpkins are covered in all of Virginia, or apples are covered in all of North Carolina. Those blanket statements are not possible, but it's really easy to check. And Adam, I'm actually going to see if we have somebody online that wants to check on coverage for a crop. I'm going to stop real quick. If you want to see if your crop is covered, you can type into the little box and I will go check it. Otherwise, I'm going to use some of my stock examples. So just bear with me, and we're there. So this is the website that was on the slide. This is from NAP, for actually NAP eligibility. So Adam, do we have anything from the chat boxes yet? The first thing I need is the state, and if we get something, interrupt me. Otherwise, I'm going to continue with my stock example here.
Not seeing anything.
You're free to throw it out, Adam, if you'd like. But
what about,
otherwise,
we do a lot of winter squash, especially sometimes with beginning farmers. But what about winter squash, butternut, let's say?
Okay, so we're in Virginia. What county would you like to use, Adam?
Let's do Lee County.
Lee County. All right, just across the line from Kentucky. Okay, so now we're going to select a crop. Okay, you're going to look here and you'll be like, what? I cannot insure butternut or winter squash in Lee County because you can see here, not listed, apiculture, corn, or whole farm revenue. So those are your choices. Well, choose not listed. If you're checking for NAP coverage, choose not listed. If you're looking at whole farm revenue, we'll talk about in a minute, but you can choose not listed. Now you go to the next tab, which is NAP crop information. So then you select a crop on that. And we're going to look for, I think it's listed as squash winter. Squash. Maybe it's listed under winter squash. Or butternut. We may have to go with just plain old squash. Crop type. So you select squash, now you can select butternut. We'll just select generally winter squash, Adam, since that's what you select practice. We'll say it's irrigated. Intended use, fresh. Planting period. Okay, so you could have an early and a late planting period here. We're going to go ahead and go with the early planting period. And you can see here what has come up. is they have the FSA market price of 33 cents per pound. So that's really low. If you're used to selling to Appalachian Harvest, or if you have organic winter squash you are selling, this is low. However, they expect about 15,700 pounds per acre. All right. But you can see that it is available under NAP coverage. It was not available from any risk management agency program except for the whole farm. So it is available, and they're going to give you some dates there. We'll go into this more in just a moment, but I just wanted to show this because this shows how you can check on what is available in your area, and it gets very specific. NAP, you know, here you can see we'll go into approved yield. We'll do all this in a later example, but I wanted to show you this tool and how it works so that later you understand where I'm coming from. So give me a moment to switch back to my presentation. And we'll get back to where we were. So, you know, it showed you important dates for your selected plan. We'll go over that in a little bit, what the different dates mean. Depending on the crop, there are different dates that you have to purchase your insurance by and give them an actual farm operation plan by. You have to pay your premium by, all those kind of things. So how would you be able to file a claim? What fits? Basically, adverse weather, any unusual natural event, almost. There's an asterisk there. So adverse weather, if it's really hot, cold, wet, dry, hail, tornado, hurricanes, all those things, they can bring into play crop insurance. An earthquake, a volcano, if due to unusually wet conditions you have an insect infestation, for example, that could actually be covered. Things that aren't eligible. If you don't follow good farming practices, you neglect your crops, those aren't eligible. If your weeds make your yield too low, that's not eligible. If there's chemical drift that kills the things that you are trying to grow, so you're spraying one field and you accidentally kill a part of the neighboring field, that is also not eligible. And we hear this a lot in Eastern Kentucky, and I'm sure it's true with the rest of Appalachia. I know it is. Animal damage. We have had everything from bears in orchards to elk in tomatoes and corn to raccoons. You know, I've actually heard of coyotes eating corn. So animal damage is actually not covered. If you think about it, those are generally usually contained events that aren't going to cause a large amount of coverage. The weather is going to cause wholesale, you're going to have a reduced yield in your entire field. So, and anything obviously that you cause through negligence or mismanagement, that's not going to be covered. If you have an irrigated field and you fail to irrigate it and you're insured as an irrigated field, that's not going to be covered. If you aren't irrigated, a drought happens, then that will be covered. So the first one we mentioned was the whole farm revenue protection. Everything in your farm is under one policy. It is available everywhere. It protects you, as the name implies, against the loss in revenue, not necessarily yield. The two are related, but not the same. If you suspect that you're going to have a loss in your revenue, you need to report it within 72 hours. So what that means is that if your pumpkin field floods, and I'm going to stick with pumpkins because I've dealt with a lot of pumpkin producers, oddly, or your winter squash field floods, you know that you are going to have a loss after it flooded. You have 72 hours to contact your insurance agent and tell them, like, hey, my pumpkin field has flooded. I'm going to have a loss. And the reason you do it then and you don't actually make a claim is because since it's your whole farm and all the revenue together, a drawback of this policy is that you make your claim within 60 days of filing taxes, because they need to wait until the end of the year to see what your farm revenue is going to be. Once you've filed your taxes and you have evidence of reduced revenue, you can make your claims. So this is a slower way. They may send an inspector out beforehand, and very commonly in insurance claim cases, they do send an inspector just to make sure you're telling the truth. There are several great examples of crop insurance fraud, so they do send inspectors out. And that's part of the reason you need that 72-hour thing, is so they can get there and see the damage. But your claim will be filed after you file your taxes. Indemnities are paid after that. You know, if you get a payout, it's going to obviously be after you file your taxes and have made the actual claim. What it does not insure, it insures a lot of things. It'll insure your livestock, it'll insure hay, it'll insure vegetables, it'll insure bees, your apiculture, it'll insure orchards, it will insure, you know, if you can, there's several things that will insure nursery plants. What it does not insure is forest products. So if you're thinking of your timber, if you're growing some non-timber agroforestry things, I don't believe, my understanding is maple syrup, for example, is not insured. Doesn't insure that. Or animals that you are raising for sports or shows. So if you are raising award-winning herding border collies, they are not going to be part of your whole farm revenue. It just does not cover it. If you are raising show horses or show cattle, not covered. So those are just some things it doesn't cover. So beyond the initial records list that I gave you that it requires, you have to have 5 consecutive years of your Schedule F, which this year would mean from your taxes from 2014 to 2018, and that includes 2014. So it's 5 years. If you are a beginning farmer or rancher, you may use 3. So, and really, if you have questions as a beginning farmer about doing a whole farm revenue protection plan, I would highly encourage you to contact your insurance agent. They do have ways of working with beginning farmers. If your farm has been expanding, I have one example of a farm who has grown twice, more than doubled their revenue in the last 5 years. So would whole farm revenue just take the average of the last 5 years? Not necessarily. If you have evidence of how you have expanded historically, and if you have evidence for the fact that you're going to be expanding this year by increasing your labor pool, increasing your acreage, you've increased your markets, those can be taken into account and they can write that into the policy. So it doesn't have to be just your actual production history. It can also be your expansion, your farm expansion. I was really surprised to learn that they are able to do that. That, for me, for a growing farm, makes this more of an ideal way to purchase insurance, especially if you're a growing organic farm. So some important dates, and these are true, the dates vary in NAP with different crops, but for whole farm, your sales date, so when you have to have your policy done and completed, is March 15th, which is part of why we're talking about farm insurance in the end of January. At that time, you're also going to have to file something called a farm operations report, which is what you plan to do this year by March 15th. Also, by July 15th, you have to give a report of what really happened on the ground, because we all have our production plans, but things happen. You have a delay in planting, you need to switch fields for some reason. You have to do your revised farm operation report by July 15th. You are billed for your premium by August 15th, and if you need any changes to your contract, that's going to be August 31st. These dates stand for all of whole farm revenue. So just to keep those in mind, that if you're considering whole farm, you need to reach out to an agent as soon as possible. So your accrued revenue, we talked about that for a moment. And we said it's the amount that you are approved to be insured up to. So for example, it's based on your whole farm history report, that 5 years. It's a form that your insurance agent should help you fill out. Your farm operations report, which we said is your plan for the current year, your growth, and also your coverage levels. So actually how much coverage you choose will affect how much your approved revenue is, which seems kind of circular, but There's a way they calculate it that works out for them. The other thing to keep in mind is that if you have something on hand at the end of the year, so for example, if you had some winter squash at the end of the year that you hadn't sold by December 31st, that inventory, the value of that inventory will be taken into account for that calendar year. So if you had $80,000 in overall sales, but you had $20,000 of squash that you hadn't received payment for, or you still had an inventory, that is going to be added to your $80,000 in sales to make you $100,000. You can't claim a loss for the fact that you still have $20,000 inventory. So that's important to understand. If you continue your policies next year, you're going to see that then. I'm not going to go too far down that rabbit hole. So your revenue will be adjusted for anything that's unsold at the end of the year. Just wanted to make that, put that little asterisk on there. So how much do they subsidize your revenue? They actually do it based on how many both commodities or crops you have. So if you have one crop or commodity, you'll see here, like they can do 67% of, if you have cover 50% of your $100,000 farm. So they'll pay up to 67% of it. And as you increase your coverage, you actually decrease the percentage that they pay, which sounds like they're paying less, but we'll show you in a minute how this actually works with a real example. So if you're doing whole farm and you have two main crops that you're growing, they're covering 80% of your premium. That's pretty nice, up to 75%. And that's a lot of your premium. If you have three, they will cover 80%, and they will allow you to purchase up to 85% of your. So if you wanted to insure $100,000 of accrued revenue, they would insure it up to $85,000. So, and we'll explain what that means here more in a minute through an example. If you want to get an online estimate of your whole farm revenue, we're going to go through this a little bit. This is a little more complicated, so I'm not going to ask for examples because it's harder to fit in. I already have one up and ready to go to show you this, and there will be a link to this at the end of the presentation. It's a cost estimator. You get a quick estimate. It's not perfect, but it will give you a ballpark figure. So if you think crop insurance is going to be outlandishly expensive, you can go see. You enter your data and you click Get Estimate. So again, I am going to stop sharing this and go over to the internet and actually show you what this looks like. So you can see here it worked kind of like the first thing. We got the commodity we chose was whole farm revenue protection. Not going to click these boxes because I already had these numbers entered in much faster than I already entered. The year was 2019, located in Kentucky in Whitley County. We do calendar year. 99.9% of people, they're almost probably everyone watching this will do a calendar year, and no practice specified. It didn't give me an option. This MPCI liability, that stands for multi-peril crop insurance liability. In this case, and in most of your cases, it should be zero. You can discuss that with your insurance agent, but it should be zero. So your allowable revenue, so you see here, it gives you the ability to put in your revenue history, so from 2013 to 2017. And then I selected 3 commodities or crops. I selected peppers, that would be sold fresh. I selected pumpkins and tomatoes, and here you put in the approximate value of what you intend to grow. So I just put in some approximate things. The next thing you do is click Get Estimates. And it's going to want to know, is this your first year of insurance? If you're watching this webinar, I will almost guarantee we're going to need to click yes. Is there any known damage to any perennial crop, anything that's already been planted, or anything you have on hand? Nope. We hope that's no. It's going to take it just a moment, or a few moments in this case. and we will be very patient. So what it's going to give us here in just a moment is going to be a thing that shows us both the premiums and your subsidies. Here we go. It took it a minute, but you can see down here at the bottom is the information we really wanted to get, liability amount. So if you ask, you're allowed, since you had 3 crops, in this example, you can get 85% coverage. And 85% coverage, they will insure you at $82,960, which means when you start dropping below that from a revenue standpoint, that's when the policy starts paying out. If you chose 50% coverage, that would be, so if you have less than $48,800 in revenue, that is when the crop insurance will start. You'll get an indemnity. You get a payout. You receive an indemnity. So you'll also notice here, so it says showing grid. If you click total premium amount, there it shows you how much it would cost. Holy cow! It would cost $10,453 to insure this at 85%. But wait, the next thing to click on is producer premium amount. Okay, so if I want to insure at 85%, I can get insurance for $4,599 to try to insure $82,000. It's not so bad. If I just want to insure it at 50%, $517. It's actually good to remember because we're going to talk about NAP in just a moment, and that is a little less expensive than 50% coverage with NAP. So, and if you want to know how much the federal government pays, click the next circle and it will give you your subsidy amount. So this is a nice little tool. It's available to you. You can go in there, put your crops, how many ever you have, however much detail you want, and get an idea of your estimate and how much you're going to get. So I'm going to switch back over to the presentation, so give me just a moment. All right. So this was in case something went wrong, I had these on slides. So we're gonna, you can see there's the same example, but here's what I wanted to show you is the premium. So for $82,000 in coverage, your total premium would be $10,000. They would subsidize $5,800 of that, and your premium would be $4,500. So you can see here how it works in practice. You know, you can go and say, okay, well, how much am I willing to pay for how much coverage? And that producer premium is what you need to concentrate on, and then your liability amount. That's when you drop below that for a reason that is not your neglect or animals or chemical drift or anything else excluded. If you, for natural causes that are weather related generally, you're insuring at $48,000 to $82,000, depending on the coverage level you select. So that's an easy way to look at it. I just want to do that real example for you all. I did a scenario. This is actually the same producer I ran. So this is Kelly, which you all, if you watched the last webinar, Kelly does a lot of things because that's my middle name. And so I choose it to not choose from anybody else. She purchased 70% coverage with an approved revenue of $97,600, which is exactly what it was in the example. And she wanted to do the 70% coverage, so she's paying a premium of $1,093. She lost $25,000 in revenue because a pumpkin field flooded, and another $15,000 in revenue because there was hail damage to her tomatoes and peppers. It was not a good year for Kelly. This is probably why she bought crop insurance. So since the expected revenue was $97,000 and the actual revenue was $60,000. So that's a big difference. Like she's missing $37,000. It's a lot of money that she thought she was going to have. The insurance isn't going to cover all of that. She was insured at 70%, which was $68,320. So she will receive $8,320 from the indemnity once her claim is approved. Yes, she paid $1,000 to get $8,000 back. If she had lost anything, like everything below that $68,000, she would get back from her claim for an approved loss. So which brings us to NAP. So that's a good summary of whole farm. Before we move on, does anyone have a question on whole farm? And I cannot see the chat box right now. So if there is one, someone stop me and let me know. So NAP, what is the difference? NAP protects farmers with uninsurable crops. So as we saw when we went through the little tool earlier, you know, winter squash was not an insurable crop. We had to say not listed, and then we went over to the NAP section and insured our squash, looked at our squash. So if you have a crop that's not insurable, you go to FSA and you can purchase NAP. If it's not covered in your county, I'm going to stick with my pumpkin example. Pumpkins are not covered under traditional crop insurance. The only way to cover a pumpkin right now with traditional crop insurance is whole farm revenue in Eastern Kentucky. However, unlike whole farm revenue, you are purchasing coverage for each individual crop. You're not purchasing it for the whole farm. You cannot purchase anything that is available to be insured in your county. For example, if wheat is available to be insured in your county, you cannot purchase NAP for wheat. You would have to go through a regular insurance agent. The reason they established NAP was to help people who had crops, that were growing crops, that they couldn't get other insurance. And so it's just most people choose the catastrophic coverage, which is more than 50% loss. And we'll go over the cost for that in just a moment. Application fee is $250 per crop, up to $750 per producer in each county. If you're a producer, a farmer with multiple counties of crops, the ceiling for how much you can pay to apply for NAP is a little bit over $1,800. So there's an application fee with NAP, not something you saw with whole farm. However, the application fee can be waived if you are, when we talked earlier about the special groups, whether you're in a certain minority group, if you're a limited resource producer, if you're female, those have been reasons they have waived the NAP fee before. So that's going to give you the very base catastrophic NAP coverage. If you want to check on NAP premiums and indemnity payments, the same website that we went to before, where we checked to see if we could insure winter squash. So it's a very useful website. You can actually get to the point that you see your premiums, which is nice. I went ahead and did an example on this one. This screen is actually a lot easier to see if you put it on the page. It has less interaction. So if you were growing jack-o'-lantern pumpkins and we selected go fresh, we're going to grow it in the first growing, in the first part of the growing calendar, you can see that they have established for you the FSA market price. This is how much they assume you're going to get per, you see, unit of measure hundredweight or 100 pounds of jack-o'-lanterns, $14.33. If you are an organic farmer or selling at a farmer's market or have a direct relationship with a buyer, this is going to be below your normal expected price, which is why most people use NAP as catastrophic coverage. They expect you to have about 16,000 pounds per acre, and which is 160 units, because it's 160 hundredweight. So you see here in this example, I actually put in that the approved yield was 160 and the anticipated yields was 160, and we were going to do 10 acres of pumpkins. And we'll assume that that was the same that she did in the previous example, that she was going to have a large quantity of pumpkins. So I just kind of chose 10 acres because you can get a lot more for pumpkins if you're direct marketing them, as I assume she was, to get a premium. So here's the coverage. So basic or catastrophic, which is greater than a 50% loss. They're thinking that you're hopefully got at least 80. If you dip below basically 8,000 pounds per acre, Yes, 8,000 pounds per acre, then this starts to be applicable. So this is their estimated premium for that. There is no premium for that catastrophic coverage. That application fee is it. Many farmers that I work with, that is what they have elected to do, just because they're preparing for an absolute catastrophe with that crop, and it's the cheapest way to get it done. So if you were wanting coverage at 50%, the premium per acre would be $60, or for 10 acres, $602. All right, and you can see the rest of them. If up to, they would do up to 65%. So they won't go quite as high as whole farm revenue, but they will go up to 65%. So if you're wondering how much they're going to pay out, so let's say that, and interestingly, although NAP calculates how much you should get based on your yield, they also bring into your loss calculation how much revenue you had. So they use a combination of yield and revenue to figure out your payment. So if your yield per acre, let's say, went below 5,600 weight, so 5,600 pounds, you can see at 65%, they would assume that they would pay you $6,000. In Kelly's example, she had $5,000 in sales. They're going to use that, and it looks like she's going to be still getting about $8,309, which is great. It's almost exactly the same as it was with whole farm revenue for 65% coverage. She only spent $700 as compared to, on the premiums we saw a couple of slides back. Let me show you. So, she spent $782. That's almost, it's a little bit less than, $220 less than she spent on whole farm revenue. And she gets her pumpkin money back. That's great, right? Except we have to think, if she wanted money for the tomatoes and, for tomatoes and peppers, she would have had to pay another premium. And she, also, if the loss was greater, she would have, she was almost to the end of the most that she could get for her pumpkins. So where does NAP become less an advantage over whole farm revenue? And where does whole farm revenue become an advantage over NAP? That really depends on your scenario. So whole farm revenue was a single premium that covered all of your insured crops. So if you had lots of losses within several different crops, let's say it was just the hail just damaged everything. You've got losses all over the board. Well, whole farm revenue might be better suited in that case. And if you're looking to insure a greater portion of your farm, whole farm revenue would probably be a better fit. Because for $300, Kelly could have insured for a whole farm, or less than $300, she could have done the whole farm rather than just the pumpkins. Whereas with NAP, that $700 premium only covered the pumpkins. Any crop that she wants to cover, she's going to have to pay another premium. Now, so keep saying she is going to get a discount on her premium for being female, assuming the new farm bill kept that in. We're actually waiting for FSA to give us specifics, but they haven't been in the office of late to review the farm bill. So we'll get the information to you as we can. So if you're only looking for catastrophic coverage for a few important crops, NAP really may be the way to go. If you're like, you know what, I've got two things or three things, and I just want, in case the worst case scenario happens, I just want enough money to be able to replant next year. NAP may be the way to go. If you're looking to actually try to insure as best you can your farm revenue, if it's your primary source of income, whole farm may work for you. The key is getting in there, looking at those estimators, calling an insurance agent. Don't just assume it's not going to work for you, and see what will work better. Why would you buy it? We've been through this. you know, right now there's some emergency loan programs because people have had farm losses. I would personally rather pay a little bit up front for insurance than have to take out a loan, have a possible lien on part of my farm because I've had a loss. This is my risk. It depends on how, I say, a lot of this depends on how risk averse you are. If you are fine with loads of risk, crop insurance might not be for you. If you're like me and would insure my big toe if I could, this might be something that will work for you, because it does help you, you know, if it's an eligible loss, if it's weather related, some sort of crazy natural disaster that isn't an animal, it's, you know, and it's not something you've caused, then it can help you for the next, prepare for the next year. If you're trying to get financing for something, this helps ensure, this looks better to banks and lenders than just than hoping the weather isn't bad. So personally, I think it provides some peace of mind for a minimal amount of revenue. You know, I say some because, again, the loss could be for something that's not covered. When you speak to a crop insurance agent or to FSA, you need to have a list of like everything you can think of that could happen to your farm. You know, I don't think it's covered, but I would ask if the neighbor's teenager took a four-wheeler and went into my field and proceeded to run amok through my lettuce, is that covered? You know, those are questions that I would ask. Like, what could actually happen? What seems like it would never happen? Volcanic smog was an example of things that were covered. None of us thinks about volcanic smog, but if you had a major eruption that had drift this far, I mean, it could happen. Highly unlikely. It is covered, by the way. But then the last reason that I would consider buying, and I'm not saying everyone should go out and buy crop insurance. You need to look at it, look at your cost, look at what it does for your farm financials, but I think it's definitely a piece of risk management and business planning. It mitigates what you can't control. There are many things in farming you can't control. Weather is probably one of the biggest, if not the biggest, and this helps mitigate your weather risk. You may have more control over your neighbor's teenager on a four-wheeler than you do the weather. Actually, I'm going to guarantee that. So it mitigates the risk for what you cannot control. So these are a few resources. We are waiting until we have final word from risk management agency and insurance agents and farm service agency on how the latest farm bill, if anything changed. For example, we know there's a new hemp policy. Don't know what it looks like because no one has been in the office to examine that for the farm bill. So that's not there. So for right now, we're going to rely on the things that they already have. They have a whole farm revenue fact sheet or frequently asked question sheet. They have a great NAP, frequently asked question sheet. And then those price estimators that I used are publicly available. Just did some internet digging and there they were. They're not perfect, they're ballpark figures, but they are what's available.